Hi, I'm Samir Jain at Active Allocator. It looks like the S&P 500 has come a long way from the March lows. It's gone up over 60%. And the PE now at 21.7x is fairly overvalued. Our dividend yield is 1.7%, which when compared to the 10-year Treasury at 0.9%, is once again pretty high. Here we can see that the PE relative to its historic level is fairly overvalued, but the price to book ratio shows some level of undervaluation. The price to cash flow is not really so meaningful because this year we haven't had too many companies with resilient cash flows. Here we see an inverse relationship. If the PE is high, if markets are overvalued, future returns tend to be lower, and that makes common sense. So right now at this PE of 21, 22, one would expect 0 to negative future returns. When I say future, we're looking at around a 5-year period, assuming that this historical relationship holds. Here we look at S&P EPS, and by the looks of it, analysts are expecting much higher earnings in 2021 compared to 2020, and that will once again make sense because we've had a shutdown in so many sectors of our economy this year. And here we can see that EPS growth has been negative for all quarters this year. And if you look at its various components, it's been negative for both margins, it's been negative revenue. So operating EPS has been negative, though if you look at the trends in Q3, this seems to be slowing down, which is a good sign. Here we can see that if you look at, for example, utilities, they've had much lower dividend cuts than some other sectors such as discretionary or energy. So overall, 63% of S&P 500 companies pay dividends because these are mature cash flow generating companies, but around 16% have announced dividend cuts. If we see this chart, we can see that value stocks seem to be properly valued and growth stocks seem to be overvalued. So there is value in stocks that have low growth, and of course this is driven by technology sector. Technology stocks are perceived as high growth, and given the run-up in valuations, those seem to be the most overvalued. So value seems to be a better place to enter the market right now. The top 10 companies are around 28-30% of the S&P 500 by market cap. So if we believe that the S&P is overvalued, we can extend this to say that it's because the larger companies that are a big composition, the large cap companies, technology companies, their returns and valuations have been extremely high over this cycle. So that perhaps explains this over concentration in the large tech stocks that have come to dominate the S&P 500 this year. Well, most of the S&P 500 companies are mature cash flow generating companies that pay out dividends. But yet we'll see that certain sectors that have been very adversely affected by the COVID crisis, for example, you look at real estate, so some sectors have cut dividends this year, but other sectors such as utilities, staples have held on. Growth seems to be giving way to value. So if you look at it, value is cheap. And of course, the reason for that is most of the growth companies are technology companies. And those companies, as we talked earlier, are largely overvalued. So this chart is a good one because it gives you a general sense of relative valuations for value versus growth. So value seems to be properly priced versus growth companies. This is something that everyone's talking about, that the S&P 500 is largely getting dominated by a few stocks. So the top 10 stocks are now a much, much larger percentage, and even within there, the top 5 are a much larger percentage of the S&P 500. So if we believe, as I certainly do, that the S&P 500 large cap space is overvalued, necessarily the underlying stocks, those big 5, 6, 7 farm stocks, are the ones that are driving this higher market cap. And if you are pegged passively to an index, you might be investing in high valued stocks and a much higher valued overall index. The data suggests that infotech and staples is largely dominated by large cap stocks. So it's a bit of a catch-22 situation. And for some of the other sectors, the dispersion is fairly even. There's nothing much that has changed. We also can see some numbers on historical earnings drawdown, markets drawdown, and how there's been a rebound between large cap and small cap. But this is historical, of course. This again is another view of performance, both quarterly as well as annually to date, between large cap, mid cap, small cap, and we can see clearly that large cap growth has done extremely well this year, almost 30%, followed by mid cap and small cap growth. This is an interesting chart because it shows the huge dispersion in returns. Certain sectors such as technology, consumer, discretionary have done extremely well, while other sectors, say for example energy, has not. So take a look at the YTD, year-to-date performance here, and getting one's sector mix right ex ante is extremely difficult, but it still makes sense to appreciate the difference between sector performance that we've had this year. This chart essentially says exactly the same thing, where one plots different sectors in decreasing order, and it drives home the point that energy, airlines, these sectors have been devastated, while others such as technology have held on. Home improvements, for example, have done well because people were mostly confined to their homes. All of this makes a lot of intuitive sense. So I thought this was a pretty good chart to get a sense of year-to-date returns and the dispersion between sectors. There are lots of folks who believe in building multi-factor models as a way to predict the beta of the overall S&P 500 as well as other indices to different factors. But what you can see here is these factors have very little predictability. So what works in one year absolutely does not work in the next year. So I'm not a great believer in factor investing, but this chart gives you a sense of that enormous variation between factors that do well one year and do not do well the next year. This year the S&P has returned around 11-12% as of November, but we've had a huge drawdown, and this was of course in March, almost 34% or so. So while volatility hasn't been too high, if you look at the maximum drawdown number, it was pretty steep. 34% is not for the faint-hearted. Thank goodness it's come back this year. The VIX is at 23. Not too bad actually if you look at all the posturing that's happened, the elections, etc. So the VIX is slightly higher than its long-term average, but this chart gives you a general sense of how the VIX has shot up during previous periods of market crisis, And it's a good forward predictor because it's used in options pricing. So volatility is fairly okay now. And of course, let's conclude with this familiar chart that, hey, invest in equities for the long run. If you want to unlock that long run equity risk premium, because one can see here, if you're looking at long periods of history, the last 120 years, there've been peaks and troughs, but the overall trend seems to be going up to the northeast. So let's conclude today's talk on equity markets with this reassuring chart. Thank you for listening in.